You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to another Profit from the Pros. I'm Terry Ruffalo. Investors watched closely as first quarter earnings season got underway this week. Stocks traded choppily as investors seem to take a wait-and-see approach to the market until they get a much clearer picture as to just how first quarter earnings are going to look. Trade data out from the Commerce Department this week showing a drop in both imports and exports in February had some economists trimming their first quarter economic growth forecasts. Stocks got tripped up on Thursday on news of a surge in weekly jobless claims that no one was expecting. And we got word that both wholesale and retail inflation ticked a bit higher once again in March, although the consumer inflation data seemed to come in about as expected. Consumer staples and energy stocks were in focus this week. The financials were the biggest drag on the market after the Wall Street Journal reported that regulators are looking at whether big banks manipulated a key interest rate, that's the LIBOR rate, during the financial crisis. And the latest reading on consumer sentiment shows a better than expected rise for the month of April, despite higher oil and gas prices. So that was one bright spot in this week's news. Shiraz Mian, Research Director, here with us once again to kind of kick things around. So there's a lot going on all of a sudden, a lot of things impacting the market. You've got back and forth this week in the stock market.
That's right.
Caused by uncertainty over first quarter earnings, it seems. You've got European debt concerns, again, jobless claims,
That's
again, right, impacting the market. With everything that's going on, is it reasonable to expect that the market is even going to find a clear-cut direction here anytime soon?
The most important thing, Terry, we need to keep in mind is the ongoing thing, which is the first quarter earnings, and it's way too early for the market to really get a handle on how the quarterly earnings picture will play out relative to what expectations are and relative to where we have come from. So the core concern and the core issue that the market is completely focused on is the earnings, and then obviously the underlying economy, the health of the recovery. You referred to the jobless claims numbers that came surprisingly a reverse trend and started moving up again. Yeah. And the first quarter GDP number, a number of folks are bringing those down, but the market seems to be buying into the narrative that it's a temporary, kind of a transitory lull or softness, and going forward in 2011, the growth momentum resumes. So the most important element for the market right now is the earnings season, and as it gets more clarity on that, that will give the market a clear direction, one way or the other.
So that's all that investors are waiting for, is clarity to earnings before they decide whether or not to bid stocks higher?
That's the most important thing. There are other elements in the picture as well. You referred to the PPI, CPI data. Yeah. The labor market, in fact, has been the most important positive thing happening in the U.S. economy lately. And personally, at my end, I don't like the jobless claims numbers the way they came out on Thursday. If we see a reversal of the positive trend that we have been seeing in the last few weeks, in fact, the last 2 monthly non-farm payroll numbers were very good. So the earnings season is right upon us. It's immediate. It's in front of us. The market needs to get a handle on all those issues that we were concerned about with respect to the earnings season, margins, revenue, supply chain issues because of Japan, that they haven't been strong enough to derail the earnings momentum. We need reassurance on that. If we see reassurance on that front, I wouldn't be surprised for stocks to move higher. Stocks feeling any pressure here from uncertainty over higher oil prices? Yes, they do. All these metrics that you referred to, the higher PPI, CPI numbers, the overall this talk of inflation building up in the economy that has a direct bearing on the market. And not to mention that it's a feedstock for a bunch of industries, and it's a major expense for the consumer, which in turn affects their spending and consumption in many other industries. So it is a major concern. The key question is how big of a hurdle it is to drag down the recovery and the momentum in the market, and that's something that needs to be seen.
So can we yet say that stocks are climbing the wall of worry once again?
They are. There's never a shortage of issues that the market is concerned about, and this time is no exception. So the earnings season and the unfolding economic picture, they're providing enough data points for the market to be busy about.
All right, we're going to kick this around some more at the roundtable. Stay tuned for that and more still ahead. Here is your Bull and Bear Stock of the Week. An oil company and a shipper are this week's Bull and Bear of the Week. Shiraz Mian here with us once again, back from segment number 1 to fill us in on what's going on with these two stocks in particular. Tesoro Corporation, better known, or maybe formerly known as Tesoro Petroleum.
That's right.
I'm dating myself now.
That's true.
The
That's
bull.
been a while.
Yeah, it's been a while.
It's a pure play refiner. Typically in the industry, we associate the refining business with one segment of a large integrated company like an Exxon or Chevron. But we do have a fairly expanding group of companies that just do refining, and Tesoro is one of them, Valero, Sunoco, all of those others. Why we picked Tesoro? Tesoro has a very focused geographic footprint, primarily on the West Coast. They are the second largest refiner in California. California is a very good market to operate in. They have very specific fuel standards that refiners from other states and internationally cannot meet. So they're well placed there. The refining margin has been improving for the last many months. There is a seasonal component to that too. There is a cyclical component to that as well. So on the margin side, these guys look very good too. And for a number of years, we have seen refiners do very good at the end of the heating season and then the onset of the spring-summer driving season. Margins have been a little bit under pressure over the last few days, but they have had an impressive run in Q1, and I'm expecting that when those numbers come out, the Tesoro shares will jump along with that. So that's the primary reason for having Tesoro as the bull.
Do the shares of the refiners move necessarily in lockstep with the drillers?
No, they move in lockstep with the margin between the price of crude and the price of gasoline and other refined products. So what they get is they capture the spread between what it costs them to buy oil and what they sell the gasoline for. So it's more the margin than the overall crude price or elsewhere what's happening in the drilling or other industries.
Okay, dry ships, DRYS on the NASDAQ is the bear of the week. Tell me something's gone wrong in the shipping business.
A lot has gone horribly wrong in the dry bulk shipping industry, and those decisions are not last few months or last year. Those decisions were taken at the peak of the prior cycle in early to mid 2008. They ordered a lot of ships. All that narrative about emerging markets consuming a lot of commodities and a lot of other and international trade growing by leaps and bounds, they bought into that narrative, ordered a lot of ships, and those ships are now getting delivered, and there is a huge mismatch between supply and demand. International trade is up, but the extent of shippers and the extent of these vessels available to carry that trade is so huge that the competitive pressures between them is bringing chartering rates down to, for some of these operators, below operating costs. Dry ships is primarily is exposed to that negative trend, and that trend is not going away. There were about 200 new ships were delivered last year, and that's keeping rates down.
All right, stock screening next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Now we're going to look at the broker triple play. Sounds like something from a baseball game. I don't know. And last time we talked about this with Kevin Matris, our top stock screener, was football season.
Completely coincidental.
So, I mean, you're in sync with the different
Right,
sports seasons, but I
right.
still have to ask you,
Right.
what the heck are you talking about here?
Well, yeah, in spite of the timely baseball reference this time, there is no baseball reference in this screen whatsoever. But you know something? We are looking at 3 very specific broker rating changes, so I guess there's the triple reference,
Okay,
right?
all right.
But anyways, title aside, with earnings season upon us, what I wanted to do is I wanted to kind of see what the brokers were most interested in. So I decided to build a top-down broker screen to see that very thing.
All right, so let's get right to the parameters.
Sure. So let's start with the very first item. What I wanted to do was I wanted to isolate the broker's top sectors. So the first one is the average broker rating, and I wanted the best 8 sectors with the lowest average broker rating. So I picked the best 8 sectors, which represents half of the sectors in our universe. And then we specify the lowest broker rating because, as you know, the lower the rating, the better.
Okay.
So then I wanted to find stocks that had the best broker rating upgrade. So the next item is this one. Percent broker rating change 4 weeks, and we looked at the top 10 stocks in each sector. This item selects the top stocks with the biggest broker rating change or the broker rating upgrade over the last 4 weeks. Since we said top stocks in each one of those 8 sectors, that means we're going to have as many as 80 stocks coming through the screen. Now, not surprisingly, it has been proven that companies that have been upgraded by the brokers outperform those with no upgrades and outperform those even more that have been downgraded. So this screen finds those stocks, and only those companies are going to be put on our radar screen.
All right.
The last item is then this. I am looking for the F1 earnings estimate revisions for the last 1 week and the last 4 weeks, and I am narrowing that list down to the top 30 stocks. So for this one, again, we're looking at stocks with the highest total upward earnings estimate revisions for the F1 period, but again, it's the 1 week and the 4 week combined. And the reason why this is so important is because we all know that companies that receive upward earnings estimate revisions, that is the most important thing to a stock's price movement. And especially now, too, if you're seeing an analyst increase their earnings estimate right before a company is getting ready to report earnings, right? Right now it's earnings season, so it's really important. If you see an analyst increasing their earnings estimates right before they're getting ready to report, it's very bullish, and it shows how much confidence these analysts have in these companies. These are the ones you want to zero in on.
All right, stocks that came through.
Yeah, there was a bunch of them. Here is 5. We have Accenture, Cardtronics, Carlisle, Hexel, and Parker Hannifin. All of these companies are great stocks. They are in top sectors. They have all seen their earnings estimates on the rise, and they have been upgraded by the brokers that cover them. I believe this makes them triply good this season.
And I ask this question a lot, but is this only for earnings season or any time?
It is really all the time. You're going to see a lot of different upgrades and this kind of thing, especially prior to the earnings and afterwards as people make adjustments, but it is good all the time.
Okay, roundtable next. Stick with us here on Profit from the Pros. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. All right, as you've heard already, inflation and earnings were the focus this week on the part of investors, and we're going to flesh out those two things a little bit more here at the roundtable. And of course, top stock picks with Shiraz Mian, our research director, whom you've met already in the program. Bill Wilton, equity strategist, joins us this time around, as does Tracy Reinick. And Tracy's been here a lot lately, but Bill is kind of a new addition. You're here only sporadically, so we appreciate you taking the time.
Absolutely.
So, Tracy, I'm going to start with you now that I gave Bill that flowery introduction. Mixed readings on inflation this week, just to say the least. So the obvious question here is, in light of those mixed readings, is inflation a concern?
Well, some of the data is showing not so much, and as you said, some is showing yes. We did get the PPI and the CPI. Neither one was all that hot. The PPI was a little hotter, so it looks like the producers are having some issues. They may not be passing it along to the consumer side yet, although we're hearing stories that they are, but it's not showing up in the data. But then you get data from the New York Empire State Manufacturing Index was out, and that showed that prices both paid and received are at the year high. So manufacturing, the prices seem to be getting hotter. When does it start to go through the economy? We don't know. And then we have the issue of high inflation worldwide outside of the U.S. We just had really high in China. This last month, another 5.4% there. So, it definitely is out there lurking around, but the data isn't showing it really hitting in the U.S. yet.
Yeah, you bring up some good points there, Tracy. Bill, one thing that Tracy brings up is businesses finding themselves, choosing between absorbing the rising costs of oil and raw materials especially, and passing those costs on to the consumer. Now, either way, it hurts their purchasing power from the business perspective, doesn't it?
Yeah, it does, but fortunately, coming out of the recession, we've seen these profit margins just get wider and wider and wider, so they do have much more room than they would in a normal environment to kind of tweak what they're going to be doing with those prices. So, we're seeing more and more companies just kind of take a little bit of a hit there, and they're still able to generate fantastic earnings on a year-over-year level. So, in this environment, like we've been saying, it hasn't become a problem yet, but it's definitely out there, and people are becoming more and more concerned at this point as we just continue to see this easy money out there that's only going to make matters worse over time.
Yeah, sure has. Tracy brings up another good point. Data out this week showing a spike, well, not a spike up, but higher inflation in China, putting upward pressure on global interest rates.
That's right.
How long before that creeps over to our shores?
Well, China has been dealing with its inflation problem for a while now. The data that came out today, the 5.4 or so number for March, came in higher than was expected. In February, they had 4.9 or something in that vicinity, and their target is 4%. And they recently raised rates to combat their inflation problem. And I wouldn't be surprised if on another holiday, the People's Bank of China comes out and bumps rates again. We don't have that issue in the U.S. yet.
Right.
The benign readings, broadly benign readings that we've been getting here confirm that the Fed will complete the QE2 program and will not be in a hurry as the European Central Bank is, or as many of the other emerging market central banks are, where they are directly dealing with inflationary problems in their economies and raising interest rates.
And that program gets completed in June, I believe.
That's right.
So then is when we'll tell the story about rising interest rates here in the U.S. or not.
Yeah, the key issue is that the Fed has been buying about $75–80 billion worth of bonds every month, and when the Fed stops doing that, what does that do to the bond market? And a natural expectation would be that rates should go up. When you don't have that demand available for it on a day-to-day basis. But we'll have to wait and see because the rates did not really drop as much as was expected when the Fed started the bond purchase program. So we just have to wait and see.
Okay, Bill, you bring up that whole topic of easy money out there. This could be the sixth straight quarter of double-digit earnings growth. However, there's some negative headwinds out there about earnings season and hanging around the neck of earnings season. Profit margins being one of the potential negatives. Are they getting toppy, do you think?
Well, for the past few years, we've had, kind of the luxury of easy comparables, widening margins, like I've said, and as those start to contract, this is where we start to get into that issue of, are they going to start absorbing costs? Because when they do that, they're going to be hiring less people, and that's when it starts to trickle down to the consumers. So, the margins, I think they're about as wide as we're going to get. So, we are up against some headwinds, like you said, for a pretty challenging earnings season right now. I'm not saying the party's over, but I think we're just a lot closer to a normal economy than a lot of people are giving us credit for.
So growth is the watchword. Everybody agrees on that
Yeah.
pretty much here. Tracy, give us your top stock pick.
I have Tractor Supply, speaking of growth, and they're growing a pretty good clip considering that they're kind of this niche retailer. They're in 44 states, but they do, they're in the rural areas and they sell a lot of tractors and farming supplies to like the hobbyists. And they have kind of an interesting product mix, and they're supposed to grow earnings about 17% this year, which is a nice growth rate. They're a little pricey at 24 times, but I'm expecting good things out of them this quarter.
Okay, William.
I've got SodaStream. It's kind of a unique product. It allows you to make carbonated beverages just out of tap water at your home. So this is kind of a, more of a hot play because it's a recent IPO. Also focuses a lot on, the green movement and also cost savings for a lot of those families that, have kids around that like to drink a lot of soda. Could end up saving you money, helping out with the environment. If it gets traction in the U.S., I think there could be some really good things for them on the horizon.
All right, make your own pop. Shiraz.
My play is also on the agriculture sector. The agriculture commodities are doing very good. Deere and Company is a direct play, both North America as also Latin America. The farmers and the entire farming economy is cash rich, and that gives Deere a very strong leverage to that economy.
All right. Short week next week, so nothing really major going to move the markets next week either, we don't think, huh?
Primarily earnings will be the focus.
Yeah.
Still the focus. All right. Hope the week ahead is profitable for you, and we'll see you next time here on Profit from the Pros.